So just a common question I see is, for a first-time buyer, should I use FHA or should I use conventional? And you may or may not know, so these are two different types of products you can get for your loan. In regards to FHA versus conventional, there's some similarities and also a few differences. Just to give you some insight, I bought my first property FHA. I had the option of going conventional, but I opted with FHA. The bar is lower when you are looking at FHA than conventional, typically with down payments, and I'll get into that in a sec here. But the first main thing with FHA is the rates are typically lower than conventional. And the rates will fluctuate. They've been fluctuating forever, but they're historically low. The FHA rate is going to be typically lower than a conventional rate, which is a benefit for an FHA buyer. So that's one of the key main points when you're first looking to buy a property. You want to make sure you have these savings. I went over that in a previous video, but you want to have the down payment, and it's also smart to have 6 months reserves in regards to the PITI, the principal, the interest, the taxes, and insurance. That's ideally what you want to have when you're buying a property, which is either a 2 to 4 unit or a single family. Same rules, I would say, absolutely apply. And this is a government backed loan. So what does that actually mean for the borrower, which would be you in this case? Since it's a government backed loan, you're going to be paying something specifically for the life of the FHA loan. In this case, it is MIP, or the mortgage insurance premium. A general rule of thumb, which is a rough idea, a lender can do this better than I, but it's around $100 for every 100K. So let's pretend your property is 300K. You will be paying the principal, you will be paying the taxes, you will be paying the insurance, but also the mortgage insurance. For 300K, you could budget around $300 a month that you will be paying for the life of the FHA loan. But over time, if that principal pay down, you either hit, I believe it's 78 or 80% LTV, you can refinance out of the FHA loan, which is what I'm going to do personally, and I'm going to drop the MIP. So you either buy a property that needs work, or I think it's somewhere around 8 or 11 years with the pay down. It might be 11. That if you pay it down for that amount of time, I'm very sure it's also a tax write-off. This mortgage interest. An easier credit score to get into the FHA game. Not as lenient for conventional, but with FHA, I think it's around a 580 or a 600 credit score. So with less credit, you could get started with FHA. With conventional, it's typical, the better your credit, the better rates you're gonna get. So it does help you on the conventional side. But if you have the down payment and your credit isn't the best and you wanna get started, it may be a better option than paying rent with a limited credit score. Finally, one of the common things, it is 3.5% down. You do have the option to pay more down, but let's just say I'm toying with this option of 300K for the property. Your down payment is roughly 3.5%. So 3.5 of 300K, you're in the ballpark of $11,000, give or take. So you have $11,000. You will have your closing cost, which I would estimate somewhere between 6 and 8,000 on 300K property. But again, this is just a ballpark estimate. So your out of pocket is roughly between 17 and 18,000 for a 300K property. And you want to have the reserves for the property. So that mortgage, probably going to be in the ballpark, I would say 1,800 with the interest, taxes, insurance. It might be 2,000. You want to have 6 months of that. So to be safe, I would say you want at least 30,000 saved before that 300K property. And that's just my own opinion. You're free to whatever you'd like to do, but personally, I think you want the down payment, you want to have closing costs. You can also factor in if you want to see if you can get some closing costs back as a seller credit or buyer credit. But ideally, you want to have those reserves on the property. This goes for a single family or multifamily property. I used it with multifamily. I think it's one of the best ways to get started with multifamily, but this is also for a single family. You want to have reserves or capital expenditures. That's going to be in any older property, especially if you're buying a property that's older, pre-1950, especially in Massachusetts. Everything here, the ranches and the first time buyer properties, typically 1950s, give or take. All the multifamilies, pre-1940, pre-1920 are approximate estimated age on that end. So we have the mortgage insurance for the life of the loan. I'm gonna likely do a refinance next year on this property that I bought, and that was in 2017. What does that look like? I wanna make sure that the value needs to hit a set number. Let's just say the property was 300, right? If you wanna refinance out of that property, you need to have, they call it 20% LTV. When you buy that property at 300, you're only putting 11,000 down. So you owe 289 on the property. To make numbers work out, you need to have 80% LTV when you refinance. That could be in 4 years, it could be in 8 years, or if you do work to the property to increase the value. But a lot of times it could be appreciation as well. On that 300, I don't have a calculator, but it's probably gonna be in the ballpark of 380. 380 or 390 is what the property needs to be worth in order to refinance. You have that 20% LTV, you knock off the couple $100 you're paying in the MIP, and your payment is a lot smaller on a monthly basis. So that's in a nutshell, that's FHA loans. The main benefits, you have the lower 3.5% down, the rates are typically lower than conventional, and you can get in with a lower credit score. So in the ballpark of 580 to 600. Conventional mortgage is a different product you could use for a first-time buyer, or if you're looking to buy a second property as well. With this, the credit score does matter. So FHA might be better if you don't have a great credit score to get started, but with conventional, you can absolutely get started. And the better your credit score, the better rate you're gonna get, and that's gonna help you out get the best terms on your loan. So this follows the Freddie Fannie guidelines. It is not a government-backed loan. Conventional mortgage is a different product than FHA. One of the major differences too is the down payment amount. With this, it does benefit if you put more down on the property. It could be anywhere, depending on the state and the type of conventional loan, between 3 and 20% and 25% for an investment property. So that's a major, major difference than the 3.5% you're doing for FHA. But you also know the more you put down, the less monthly payment you're gonna be doing, and you're gonna be paying a lot more towards the actual principal and not the interest like you are with FHA. So typically more money is involved with conventional mortgages. That's not always the case, but more than not, you are putting more money down. You have less payment, but you have a more LTV as well. The rate is slightly higher than an FHA. Keep in mind that FHA, government backed, lower rates, lower credit score needed. Conventional, slightly higher rates, but you need more money to get involved, and it's highly dependent on your credit score. You're gonna have a lot more favorable terms if you're a 750 credit score than maybe a 700 or a 680 credit score. So that is going to factor in on what you're gonna get in regards to the rate and what you're gonna get in regards to your loan. So if you are on the fence and you're not entirely sure what to do, what I would personally do is I would kind of map this out on a side by side, go through how much down payment I need, go through how much reserves I'm comfortable with, and that may paint a better picture down the road of what product is better for you. And one of the factors here with conventional is the insurance. The mortgage insurance drops automatically instead of FHA where you have to refinance out of that loan. Since that mortgage insurance is for the life of the loan, with conventional it drops automatically. Keep in mind, you can only have one FHA loan at a time. So you simply cannot buy a property with FHA and then buy another one next year. I mean, that would be pretty crazy if you can do that. Folks would be able to level up very quickly in regards to number of units for multifamily or buy multiple properties. But you can only have one FHA loan at a time. And what does that look like? You need to be able to refinance out of that property. Ideally, once you hit that 20% LTV, then you can use FHA again. That's exactly what I plan on doing. Definitely want to use FHA again, get into another property, 3.5% down, but also know, the option to go conventional is there, but the way I personally see it is, in my 20s, I can build a portfolio by using FHA, they call house hacking, doing it again, and able to acquire units this way. Just because 3.5% down, I'm not putting 25% down or 25% down on these multifamily properties. I think it's critical to look at your own situation, right? Whatever works for you. If your first step is you're looking at the savings goal. How long do I need to save until I need to buy a property? Or you have the down payment, you've already connected with the lender. Then you want to select, what properties you're comfortable with. If you're looking for a single family, if you're looking for a single family house hack, which you buy a huge, 3 to 4 bed property and you rent out the other rooms, or you're looking for a 2 to 4 multifamily or a condo. Plenty of options out there, but you want to exactly figure out what is best for your situation, not just short term, but long term, because real estate, long-term game. So overall, I hope you found this helpful. I hope it gives you a better picture of exactly what FHA versus conventional is. Again, I'm a real estate agent, I'm not a lender. And any questions, please drop a comment. I'll respond to every comment there. The major difference between an FHA and a conventional, in a nutshell, FHA, you have the lower down payment, 3.5. You have the lower credit score to get in, 580 to 600. And you have the MIP for the life of the FHA loan. Conventional, you have a higher down payment, you get better terms typically, but you have a higher interest rate because it's not government backed, and you do not have to refinance, just like you would with the FHA. Hopefully you can find out and then you can figure out what works best for you and get started on your purchase.